Hey everybody, welcome in. Listen, I am recording this on the road, so I am pre-recording it. So if something happens between Monday and Wednesday, I am recording it Monday the 20th. So we're going to release it on the 22nd. So listen, thanks so much for stopping in. Today we're going to talk a little bit about the Strait of Hormuz, but in a different lens. We're going to take a look at where we've been, where we are, and where we're going. This is part of what we go through in Energy Rogue, and this is part of what we do to dissect what is happening out in the marketplace. So let's go ahead and dive in. This is a tool that we use every single day. So this is Rogue Radar, which is part of our services. I'll explain that a little bit later. But what I really wanted to dive into is we're still talking about the Strait of Hormuz. And as you can see that there's not a lot of activity. I'm pulling this up Monday midday. There's not a lot of activity going through the Strait of Hormuz. Normally about 140 ships travel the Strait of Hormuz every single day, 120 to 140. And over the last probably 10 to 20 days, there's been anywhere from 5 to say 20. I've seen up to 30, but 20 is kind of the max. And there's a lot of geopolitical reasons why, a lot of, well, political reasons why. So anyhow, let's go ahead and dive into what it actually means. And so what we have in our Rogue Radar system, which is filled with supply, demand, imports, exports, everything that you're going to want to know on oil and natural gas, gasoline, diesel, jet fuel, NGLs like propane, ethane. All these markets are covered within an $89 a month subscription. So down here, we actually track. I've got to relabel things because I have not removed UAE from OPEC reporting. It's only a label change, but it is an important one, an important distinction to make. So one thing that I want to cover is I'm going to look at OPEC and I'm going to look at OPEC plus. Let me increase the size on this so it's a little easier to read for everybody out there. So there we go. Okay. So let me start down here. So the EIA, we take two reporting processes. We take a look at the EIA. We also take a look at OPEC. They sometimes have differences. Sometimes those differences are very large. When it comes to supply out of the Middle East, I always look at OPEC because it's more frequent, and I believe it a little bit better than our numbers from the United States out of the Energy Information Administration. So the last report came in March of 2026. So this is February right here, and this is March. There we go. There we go. Anyway, I was trying to draw. I want to bring your attention to a couple things. Saudi Arabia, 12.6. Iran, 4.79. UAE, 4.6. Iraq, 4.59. Okay. And then what we can see is in Kuwait, 2.88. What we can see is a very stark contrast of Kuwait dropped, say, 1.5. And sorry, I'm not the best drawer here. So Iraq, about 3 million barrels a day. UAE, about 2. I am rounding. So, and Iran, not that much. I'm actually going to call that kind of a zero effect. It's really 500,000 barrels, but I'm going to call it a zero effect. And this one, about 3. So the big ones, Saudi Arabia, UAE, Iraq, and Kuwait. So 3, 2, 3, and 1.5. Now, the most recent report that we have is Saudi Arabia at 6.5, 6.85, That's down from 12.6. So that's almost 6 million barrels a day. UAE 3.8, but I want to point out something. They added 1.6 million barrels a day, and I'm going to explain why in a minute. But from this is looking at June volumes versus May. So they added 1.6. Iran is down to 2.44. Okay. Iraq, let's see what Iraq 1.97. And these are production numbers, so there is in country usage of their production. Kuwait 1.45, about the same. So when we look at how much oil is down, Saudi Arabia has about 6 down right now. UAE is only down about 1. Iran is down about 2. Iraq is down about, I'm still going to call it 3. And Kuwait is down about 1.5, something like that. Okay. So when we add this up, 6, 7, 10, 12, 13 and a half. So that is 13 and a half. Now this does include liquids, which means liquid products, which is a lighter level of crude. So out of the 14 million barrels, I would probably say 9 is real dense crude. The remaining is light products or crude. So that is how much is down right now, a 14 million barrel a day outage. So when we have a supply and demand impact of 105, which is where we were before the war, expected to be about 105 on the supply, 105 on the demand, we're down 14 million barrels a day, 90, right? And that 90, well, I'm rounding, but that 90 million barrels a day is offset by two things. Demand destruction, which is when prices rise, there's fewer people to consume it, so they stop driving as much or they stop ordering as much because the inflationary impact that is passed on in the fuel cost. So that is one way this gap is bridged. And another way this gap is bridged is by stocks. So stocks is another fancy term in crude oil for the stored crude, and that stocks is being drained in the United States, in Canada, well, North America, South America, Asia, and Europe. Those are the core areas that stocks are being taken out. And I'm going to go up to our stocks in a minute, but I want to root this with out of this difference, this 14 million barrels a day. So when we have 14 million barrels a day of supply, two things will happen. One, demand will be stopped one way or another. Either price will get prohibitive or there's going to be curtailments. As a matter of fact, Australia and Asia has a lot of curtailments or need to restrict fuel consumption because this is a very, very large, very, very large supply impact. So, but what I've heard is about 5 million barrels a day of demand destruction. And that means that roughly 9 million barrels a day is coming out of stocks. So this is being that's temporary storage. And there's a number of days that Europe can survive on those stocks. There's a number of days that North America can. We track the United States number, and I'm going to show that to you in a second. So this basically means how much food is in the pantry. And if food stops and food escalates in price, how much food can we survive? Let's go ahead and take a look at it. So we have, let me scroll up and not there. There we go. Okay, so we have commercial crude stocks in the United States and SPR. SPR is owned and operated by the government, or not owned and operated, owned by the US government. And commercial crude is an aggregate of all the commercial players. These may be Exxon, these may be large refiners out in the marketplace. So what happens in these market type of events is commercial crude is going to be a dollar player, meaning if it's higher to liquidate the stocks and replenish it later, they plan on doing that. SPR is more a inflationary relief valve, and this was used a couple of times before, and I'll show you a little bit in Rogue Edge, which is our other product. But 316 million barrels of supply. What does this translate to? 24 days. So that means if we just kept drawing at this rate, that will give us 23 days of supply, 24 days. So that is kind of a quantitative. If everything stops today, we have 24 days and then everything hits zero. Now, of course, the United States is not the same when it comes to that. And I apologize for the phone in the background. It'll disappear in a second. But but with that disappearing, we're not truly going to disappear because the United States has a lot of crude oil production. And that crude oil production is about 13.8 million barrels of production. And that means that we're not really going to go to zero. So that's what that essentially means. But let's get back to the point. So the point of the story is that when we look at all the supply side, and let's paint a picture. Let's say peace is resolved today. There are hundreds of ships that need to exit the Strait of Hormuz. So there's all these ships that are trapped. Now, some of them have flown out and they have to go to destination. They're going to take about 20 days to get to destination, sometimes up to 30, sometimes even 40, but say 20. Then they need 10 days to return. And that means that we have a month of just removing the ships from the Strait of Hormuz and then putting ships back into the Strait of Hormuz to start loading up traffic again. So that means 1 month. Okay, I'm gonna mark the months here. That means 1 month of just reconciling or backing out the ships. Month two is actually as Europe, the United States, and Asia has drawn down their stocks. The Middle East has added a lot of stocks or storage. They have overflown their storage, is they had to start shutting in production, and the longer they stay shut in, the longer that supply is going to be down. So I think that there is another month of exiting storage to get it to destination and get it back in time to refill again before production starts resuming. So that is 60 days. Then we're going to start to see in month three some production go back on. However, there is one problem. The number of ships that can transport crude oil has not changed, and there was not a lot of excess ships that were sitting around, sitting idle. So that means that we are going to go through maybe a 20% addition each month, or maybe even 25 if we're aggressive, which means we're going to take 4 or 5 more months. 2, 3, 4, 5. So what is this? 1, 2, 3, 4, 5, 6, 7. So I'm targeting 7 months before we attempt to get to equilibrium and actually return that production to market. So what this translates to is when I look at the current price and the current dynamics when I'm looking at crude oil, and I'm looking at crude oil, and we do offer predictions in our resource. Of course, I'll cover that in just a second. But when I look at $80 crude oil, I don't think we should be below 80 or even 90 or even 100 right now. I think we should be way higher because this is not factoring in all the different supply problems that we're going to have over the next couple of well, over the next year, really. At 7 months to start to return production. Well, what's the demand going to do? What does that mean for the demand side? That's really going to dictate a lot of the crude oil pricing. So let me tell you a little bit about Rogue Radar and Rogue Edge. This is our product. We offer a PDF report. Some people view us as a newsletter. We offer a video digest twice a week where I walk through the markets. You can see me right down here in the same place. I just did our morning update today where I talk about the markets. I actually walk through these things that are indicators of what might be happening out in the future. So I walk through the market. You get a PDF report, which let's go ahead and pull that up. That is how many pages? 8 pages. And you get that twice a week. And this report has a convenient red light, green light system for crude oil. And it has fundamentals such as supply, demand, imports, exports. As you can see right here, we're talking about the US-Iran conflict. That's a bullish. Strait of Hormuz, that's bullish. The mediator proposals, that's a watch, that's a monitor. The SPR level is bearish because we are drawing that down. So we cover that for natural gas and crude oil, and we come up with a Monday game plan, which gives you everything to watch for the week. Then it gives you a base case, bull case, bear case, and wild card, meaning what is the expected case, what is the bull case, what is the bear case, and what is the wild card. And as you can see here, for this week, I have a gap filled. There was a technical gap up around 85, and I saw 82 to 86, 85.94 to be exact, as being the target. I've actually been talking about that target for a couple weeks and that's why it's been in our base case. And then we take a look at the bull case. The bull case, and we're not financial advisors. This is not trading advice. Use your own research. Read the disclaimers below. The bull case is confirmed escalation. Now, this is actually where I'm leaning to. The base case is this is what I think will happen. The bull case is where I believe it should go if we're actually tracking fundamentals. When we're looking at pricing in crude oil markets and natural gas markets, there is a technical or financial aspect, and there is a physical or fundamental aspect. And I lean more towards the fundamental, and the fundamentals point to triple digits. That's where I reside right now. Just my humble opinion. Bear case, we have a mediator framework in that we drop back down. Again, as we just mapped, there's still 14 million barrels a day that for 90 days isn't going to return. That's not going to return. We're just going to be adding that. We're going to be trying to climb back to that over the next 7 months. And bear in mind, we're going to have added demand because all the countries that drew down their stocks and storage are going to have to replenish. And the reason that I say that is because of right here. Let me show you. This is for our Rogue Edge, which is also one of our products. I'm going to stay on this right here. Nope. Storage and stocks. Go. And boom. Okay. Let me show you something. This is the Strategic Petroleum Reserve. I'm going to remove the 5-year min and max from this chart. And if you look at this chart, this is taking us all the way back to 1992. 92. Well, right there. So we had about 600 million barrels in SPR for most of the 90s and into the 2000s. Then we started adding more supply in the United States, and we started adding supply to our Strategic Petroleum Reserve, which we stayed between 650 and 750 until we hit COVID. We had some price relief there and other activity. I'm not sure why we drew down. Maybe it was for budget reconciliation. The Strategic Petroleum Reserve and why we use it that way has changed over time. So that is something to consider. And then you can see during COVID and during the Russia-Ukraine war, which was 2022, we took this all the way down to 350. And then we started building back up, got over 400, and then we've drawn down a significant amount since the US-Iran war. But essentially, we walk through these cases every single week so that you're not caught flat-footed on natural gas or crude oil markets. And we cover that in a video twice a week, in a PDF report twice a week. And that is Rogue Radar, which is $89 a month. There is a link below. And if you follow that to this page, you will go down, and if you look at right here. So $89 a month gives you access to the daily Rogue Radar, which is right here, which is everything that you're going to want to know on the fundamentals and technicals. Plus, you're going to have access to the video and the Monday game plan and the PDF. So that is what you get with Rogue Radar, which is $89 a month. And with Rogue Edge, you actually get access to our 150 interactive downloadable charts to where you can actually highlight particular areas and start to construct, why did this happen this way? Why did this go this way? So, and in Rogue Edge, which is 179 a month, you get right here. You get access to crude oil, natural gas liquids, ethane, propane, isobutane, normal butane, refined products, diesel, gasoline, jet fuel, electricity, rigs, maps, and we actually track whether production is expanding or contracting. So that is our offer, is $89 a month for Rogue Radar, $179 for Rogue Edge, and I would love to see you inside. So listen, I am going to go ahead and wrap this up because I've been rattling for about 20 minutes, and it's just me today. Bill is out today, so and I'm on the road, so I'm just recording it when I can. So listen, thanks so much for stopping in. I hope this explained a few things and why there's a little misguided expectation on when that 14 million barrel a day gap is going to refill. I don't think it's going to be quick, and I think we're in for a long ride. And my opinion is price should reflect the fundamentals, and we're not quite there right now. So listen, thanks so much. Thanks for stopping in. Talk soon. I'm Brian. Reach out to me below, and I look forward to hearing from you. Talk soon.